Hello everyone and a very warm welcome to today's major markets update for Saturday, February the 1st, 2025. It is already the second month of the year. How time flies by. We have just had about 20 trading days in 2025. And the big question is the bull market over? And long story short, no, we don't think so. There's many ways to assess the market. There's many ways to be successful in the market. However, we find the Elliott wave theory to be the best tool available to forecast where markets will go, and also one of the most profitable ways to assess the markets. To each their own. I don't piss on others, so please don't piss on me, right? That is how it works, because nobody can be right all the time. There are no market gurus. We get it about 70% of the time correct, with about 95% accuracy. We just have the track record. Remember, we've essentially been correct since November last year. That's quite a long stretch. Did we get every twist and turn correct? No. Did we know that the correction that started in December into January or something like that would turn into a double zigzag? No, we start off with a simple zigzag. Why? Because we cannot predict the future, and all we do is use our textbook to say, well, it's most likely going to be 3 waves lower, while knowing that it can always turn into, for example, 7 waves lower, right? Impulses move in 5, 9, 13, and of course, corrections move in 3, 7, 11s. That type of difference between a impulse higher and a correction lower. And we've nailed the target zones since we trade price. We've been doing pretty well. In the end, please remember that trading the short term is always fraught with more variability and less certainty than trading the intermediate to the long term. Long-term markets trend higher, with, of course, the occasional bear market in between, which can be devastating. And bear markets can also be for somebody who day trades, where a market drops 5, 6% intraday, or even 1 or 2%, and it's going against your trade. So that's why it's always important to have a stop loss in place. It is an exit strategy. An exit strategy means you get out, because it's better to wish you're in the market than to wish you're out of the market. And those stop losses, I cannot tell you where to set them. It is, of course, dependent on your risk profile, on your time frame, on your type of trading. You can name 1,000 reasons on why everybody has different stops. It is all good. That is what makes the market. I prefer to make rather 100 times 1% in profit than trying to go for a one-time 100% profit. Why? It is just easier to make 1% than it is to make 100% in one trade. But in the end, long time frames always go for big gains. You cannot make 1,000% in 1 minute, but you can make maybe 1,000% in 1 decade. So that is always something you have to weigh off, right? What is your preferred time frame? What are you comfortable with? All those things. I cannot tell you that, but we can work on it together if you so desire. Because remember, losses will always stack against you. The odds will always be against you. This is not may the odds be in your favor, according to the Mockingbird movies. No, this is the odds will always be not in your favor if you make losing trades. So that's why we have the stop losses. I cannot hammer it home often enough. And if you still need help, please remember we have many ways for you to provide you with fantastic services. Please dabble in the cryptocurrencies. Remember, cryptos are actually less volatile than the stock market. Believe it or not, I can show you proof. We can use ETF trade alerts if you need some help. They've been highly successful last year. A little bit off to a shaky start this year, but I still think overall doing pretty well. I got to do the stats for this month, but I think we're doing good. Especially on the Dow, and of course trade the Magnificent Seven. I think we've done really well on earnings on Apple. We've done well on the earnings of Netflix. We've done well on the earnings of let's see what else was there. Tesla, where we just stayed in cash. Microsoft was not a good one. Apple we were already long. Netflix we were already long. Netflix was up 15%. So there will be winners, there will be losers. Always the case. Don't get bogged down by losers. If you have any trouble with it, please contact me. And last but not least, also our gold and miners trading service is for premium members only. And we're still expecting a big bull run pretty soon. All right, all that out of the way. I'm saying this for all the new members that have signed up. Let's go straight to the chart, starting with the NASDAQ 100. This is option 1 we are now tracking. We completed red wave 5 here January 4, January 13, I believe. We did get 5 waves up with a extended wave 5. This is based on closing prices. So red days are 2 and 4. So those are corrective 1, 2, 3, 4, 5 up. And then, of course, we had that terrible Monday based on DeepSync or Seek, whatever it is, a Chinese AI program. It's going to be bad for the semiconductors in general. Is it going to be earth-shaking? No. Will tomorrow be Sunday? Yes. Don't think too much of it, in my humble opinion. And since that low on Monday, we have rallied really nicely. However, that rally still looks better as 3 waves. Okay, the preferred scenario was for a ABC path. And yesterday's high certainly got very close to invalidating our ABC path lower. So with that, we can have, for example, this gray path underway. Okay, so we've just topped on Friday for gray A of green 3/C. We're now going down for gray B to about 21,200 plus or minus 100. And then we rally for C. Remember, Amazon and Google are still to report earnings next week. And I think overall, market has reacted quite positively on earnings. Tesla was up. Apple was up, closed down for the day. But still, it rallied really nice at the open. Sell into strength, raise your stops, and you have a winning trade. Microsoft was down. Let's see here. What else was there? Netflix was up. So I think overall it's been reasonably well. So we got to wait for those 2 big boys to. Meta was up, of course, as well. Report their earnings. And Meta, we've been long for a long time. Wonderful trade. No worries there whatsoever. Anyway, so this is option 1 that we've completed green A1 and 2B on Monday, and we're now in 3C, which is going to subdivide once again in an ABC, just as we did all September through December long. These ABC patterns, they are less predictable than a standard impulse. That's unfortunate nature. Again, I can't count this as 5 waves up. It cannot be the top of this red wave 5 because we did not make a new all-time high. Very simple. So this must be A1, 2B. Okay, and then the other option is that this wave 2B is going to subdivide a little bit more, and we do have this B wave higher, and wave 2/B is going to become a flat. Again, I cannot predict the future, but we know the warning levels. Remember, so if we go below 21,190, most likely this is going to turn into a flat. That should bottom out at around 20,890-ish, plus or minus 100, somewhere around there. We don't know yet if it's going to be a running flat, a regular flat, or a irregular flat. It will require a lot more price data, probably a whole week almost, to figure that one out. But we would probably go back to where we came from. That is about Monday's low. So you see the difference. This one's pointing lower, then higher. This one is pointing a little bit lower and then higher. So overall, it seems to be the case. This whole idea, this hypothesis is, of course, invalidated if we open or go above Monday's high. That's, of course, the final warning level for the bears. But for now, these are my 2 preferred scenarios. I'm not showing the hourly charts because they are so messy, overlapping. I cannot make any soup out of it. I've tried. It's just a little too much variability. And I really want to steer more and more away from the shorter time frame charts. I've not even showed 5-minute charts for a long time, and I think it really has improved our analysis because Elliott wave works best on, I would say, the intermediate to long term. Short term is an interpretation issue. You have so many scribbles. I would say stay away from it. But overall, we're still above the Ichimoku cloud. We're still above the long-term uptrend in the long-term uptrend that has been in place since August, September last year. So there's really no big reason for concern. I don't see this crashing all the way down to new all-time lows, not anytime soon. No, some have much bigger declines around the corner, and it might be true, but that's why we have our warning levels in place. Okay, the ultimate line in the sand for the bulls remains, of course, the January 13th low. I've not even put that on the map yet. For this wave count, A1, 2B, I have, of course, Monday's low. The same here for this one. I have still Monday's low, and I should, of course, lower this one to here. All right, this is of course the January 13th low. To be honest, then it can't be a 2B anymore, which is a 25.24. 25.24. So that's the warning levels. Okay, and I'm going to lower this one here as well to, I would say, this level here, which is a 28.89. 28.89. Why? Because we're tracking here, in this case, this 2B wave. Okay, and here we go. The rest looks pretty good. So we've gone below the first warning level for the bulls. So the second warning level is then at Thursday's low, etc. So if we go below 25.24, then this is not a 2B anymore. This is not a red wave 4. But the odds for that I find low. It doesn't mean there's no odds for it, but I find it low. And I'll show you a option using the NASDAQ, then the red wave 4 will just be projected forward in time. All right, moving on there. That is, let's see. No, sorry, this chart. Bigger picture, right? It's the end of the month. Let's review the bigger picture. So we believe that 2000 was a cycle 1 top, 2002 was a cycle 2 low, 2008 a primary one, 2007 a primary one, 2008 a primary 2, that we completed primary 3 in 2021, completed primary 4 in 2022. We have a quite similar length in time for primary 1 and primary 2. It's about a year. And cycle 2, as you can see, lasted 2.5 years. So we're still not in this cycle 2. From a timing perspective, this makes more sense. We've broken above this long-term trend line. I know we have only 2 touches here. Of course, the 2000 high and the 2021 high. And we've broken conveniently and decisively above it. All right. It held several times now, held here and it held here. And this breakout is legit. So this is still part of primary 5 of cycle 3, and then we'll get cycle 4 to be determined, but probably is going to retrace all the way back to the 2022 lows. Looking at this chart from a real quick point of view, it doesn't look ready yet to turn over. And also here, this wave count is slightly different than that of other indexes because the NASDAQ 100 did not go below the 2002 low back in 2008. So this is a primary 1, primary 2. All right, S&P 500, same deal. We can just be in this B wave here. So we have completed an A, a B, and a C. Remember, we view this as a larger diagonal path, and diagonals are made up of ABCs. It can also be a 5, 3, 3, 3, 3, or can be a 5, 3, 5, 3, 3, 3, 3. I can show you many different diagonals actually, and they don't necessarily have to be a 3, 3, 3, 3 from an ending perspective. Okay, neither do leading diagonals. There are plenty of options out there, real life options that show quite a variability in diagonals. And when Mr. Elliott designed his Elliott wave, he had very few data points for diagonals. So he just came up with a leading diagonal as a 5, 3, 5, 3, 5, and an ending diagonal as a 3, 3, 3, 3, 3. Well, there are the variations to it. So bottom line is, in this case, it's all ABCs. Okay, so this rally here from September into December, I don't know how to make this into 5 waves up. Maybe you can, I can't. Thus, we can still see an A, a B, and a C. And this B wave should then bottom somewhere back around, I would say, 6,000, plus or minus 20. And then we go for gray wave C into the green target zone. It's really large because we don't know yet if we're going to see a C is A or a C is 1.61 times A, for example. Or are we going to see 4 and 5? Okay, to be determined. I don't know yet. And please note this Alt 3 here. And the Alt 3 is from a bigger picture perspective, and it's starting to grow more and more on me. Okay, then I'll have to relabel everything. That's fine. Potato, potato. It doesn't matter if we label it major 4 versus intermediate 4. We just move the goalpost from a labeling perspective. All right, labels don't mean anything. What matters is getting your price correct, right, and the direction correct. Also here still looks like a good, strong uptrend. We're still in this uptrend line or channel, and this still looks probably like more like a correction within a long-term uptrend. However, as the Nasdaq, you can see we still have only 3 waves up. So that puts a little bit of pressure on the idea that, yes, we indeed, we could go lower, revisit Monday's low once again, potentially as low as about 5,900 before we move higher. Okay, so again, similar to the Nasdaq 100, here we go a little bit lower over maybe the next 2 days and then higher. And here we're going to take, probably a couple more days into February to go lower and then higher. So both look for lower prices now. This is all contingent on holding below Friday's low, of course. So the warning levels for the bulls are on the chart, and these ones are still correct below 5773, January 13th low. And this whole wave count in any form and fashion, even the previous one, is off the table. But that's not our preferred scenario, as we do see the rally since January 13 into January 21, I believe it was, 22, as 5 waves up. Loud and clear on the Nasdaq 100, pretty clear for the S&P 500, and also pretty clear for the Dow. And remember, we made a new all-time high for the S&P 500. So that's, of course, very encouraging. Stock charts once again changed the whole label. I just did it and it did it. Never mind. Moving on to the bigger picture. As I said, this wave count starts to grow more and more on me, that we bottomed in 2020 during the COVID lows for primary 4. We put in a monstrous major 1 and quite a deep 2. And we're now in 3, and then a 4, and then a 5. This 4 could also be a year-long correction, and then a 5, all the way to potentially as high as 7,700 on the S&P 500. All contingent, of course, on holding above our warning levels. But I just wanted to point out this uptrend we're in. This is the channel, and we're still at the upper end of this channel. So nothing has been broken. We're above the 10 months, the 20 months, the 50 months, the 100 months, the 200 months. All of them are rising. This is a 100% long-term bull market. Okay, there's nothing bearish on it. I haven't even included the Ichimoku cloud. Let's add the Ichimoku cloud as well. And what do we get? Look at this. This is a strong bull market, and it's been a strong bull market for a long time. Let's move back here 20 years and forget all the labels. So you see here, this is a bear market, right? See this difference? See where we're now. Long-term bull market. So there's no reason to believe that the bull market has stopped. Nothing at all. There's zero indication this is the case. Okay. If anything, everything looks long and strong. Look at the MACD. It's making a new all-time high. That is fantastic. That suggests we're going to see higher prices. We need to see, of course, divergences on these technical indicators. And for now, I see none. Yes, we're a bit overbought, but as you can see here in 2017, overbought can get way more overbought. Overbought can stay overbought. Okay, so this is not a trigger. This is just a condition. And most of the time, it's quite healthy for a bull market. The long-term trend is up. So no, I have zero signs, zero indication this bull market is over. Not even close. If anything, we just did a nice, let's see here. One is one relationship here at 61.21. We got as high as 61.28. That's typical for a third of a third wave relationship. So is this a larger ending diagonal wave 5? Yes, very possible. So primary 5 likely will become an ending diagonal based on the Dow Jones, which I will show in a minute. And then we should top somewhere between, so the current high and 67.49 at the, ideally 67.49 matches reasonably well with here this extension here, 64.91. So this is $500, 6,500. And here we are at 67, so off by $250. Okay, if we do the bigger picture extension. But, you know, $250 in that sense on $6,500 is not too much. That's off by 3.8%. So that would be very close. All right. So this is our preferred bigger picture path based on also the Dow Jones, which I have shared with you before. All right. So here we have the Nasdaq 100. Remember how it went and how it's going. I believe December 6th, we were looking for a top here and then a bottom here. And then I think January 6th, somewhere we rallied to here, bottom here, and then rally. So far, so good. I see zero reasons to change the tune. Still a question mark on this wave 4, of course, because we haven't made new all-time highs. We did for the S&P 500, so that's confirmed, and I think that will confirm the other indexes as well. With, of course, the possibility of a protracted wave 4. Okay, then this was a B wave, and now an ABC lower again, and then we essentially have a triple zigzag. So this would be ABC, ABC, ABC. Okay, it's very possible. It's a WXY within a WXY for the true Elliott wave aficionados. But overall, still in a long-term uptrend. This is the ultimate bearish scenario because I'm still missing a fifth wave higher from the August low. I cannot count this rally from September into December as a three-wave structure, meaning 1, 2, 3. So that would be then 2, 3, 4, 5. It doesn't match with the channel we're currently in. So these are the two options I'm seeing. So this is the most bearish one, and this is the one I mentioned for the S&P 500 and NASDAQ 100 as well. If we go below, of course, the warning levels that we have, right, the January 13th low, we'll have to move the red wave further forward. All right, onto the Dow Jones. Looks like 5 waves up to me. No all-time high yet, but very, very close. So the warning levels are still in place. I think we just closed below the first one by $1. We had it at 44,545, and we closed at 44,544.66, just below it. So I think this green 2B is underway for the Dow Jones. And remember, the Dow Jones is not the same as the other indexes, okay? So the Dow Jones can decline a lot more and the other indexes not, and still, of course, be within the same bigger picture pattern. This is our preferred scenario that we're then in this 2/B. Don't know yet where we're going to bottom. Could be about 43,800. Could be as low as 42,500. All right, all within reasonable retraces. But let's make it nicely in the middle, is say about 43,076, somewhere out there. And then we get 3C, 4, and 5 question mark, because we don't know if we're going to get 5 waves up. Since we believe this is a ending diagonal, a ABC advance will do as well to complete this 5 of 3. So the warning levels for the bulls are on the map. Again, the January 13th is the ultimate line in the sand for the bulls versus the bears, right? If we go below that one, we have to really reassess the bigger picture as well. So I think that is the GTFO type of level for most people, okay? But for now, still looks very good. A nice, strong rally up. Again, you can see the difference between the Dow and the S&P 500 and the NASDAQ 100. Looks good. I like it. So I've been able now to put in a retrace target zone. I don't know yet exactly where we're going to end because we just have one candle lower. We need a lot more data. And if we get oversold, my dear friends, so the RSI 5 is going to go below 30. I think those are good indications that a buying opportunity is around the corner. Bigger picture wise, this is our preferred wave count, the 1, 2, 1, 2, 1, 2, 3, 4, 3, 4. Okay, so far so good. And here you can see that 1A, 2B, 3C, right here smack in this ideal wave 3 target zone for an ending diagonal. Also here, this is still a 100% bull market. Let's add the Ichimoku cloud for fun as well. And yes, this still looks really good. We don't need to project anything forward. The Ichimoku cloud does that already for us. Well, maybe we should, so we get all the labels on it. We're going to add another 10 months. There we go. No, let's add another 10 months to it there. And we can see we are still nicely in a long-term uptrend. This is a long-term uptrend. We need to break below this trend line that connects the 2020 low with the 2022 low with the 2023 low to tell us that this uptrend is over, which is about the 20-month simple moving average in this stage. We're nicely overbought, but as you can see, overbought is not really a condition for lower prices. If anything, overbought is a condition for higher prices. And we can always get a lot more overbought, just as I showed you for the S&P 500. The MACD is making new all-time highs, so that is neither bearish, okay? And everything else being equal, this is a 100% bullish chart. Doesn't matter what this is. If I look at a chart like this, this is where I say, here I buy the dip at any time because that's a low-risk buying opportunity because it's a 100% bull. bulls always top in a 100% bullish setup, but we'd like to see some divergences at some point. I don't see any yet. So this is still looking really good in a long-term uptrend where we are at the upper end of this uptrend. Okay, this part you can see there. So we should see this pullback, then 3C, a 4, and a 5 can reach even to 51,983. Okay, so that matches all reasonably well. We'll watch out for the extensions if possible. Okay, so once again, even the Elliott wave does not suggest that we have put in a top. I see nothing. We need to break, in this case, all the way below 38,000 pretty much to suggest the top is in. Now let's go over market breadth. Bullish percent index for the S&P 500 looks strong. It actually was up yesterday. That's really good. Bullish percent index for the Nasdaq 100 making new highs. That's also a good sign. New highs since the January 13 low, that is. That's a good sign, suggests this rally hasn't completed yet. Looking at the AD line, you can see the AD line increased into Thursday, whereas actually price was about the same between the 21st and Thursday. Okay, and that's quite interesting. And this starts to suggest we'll see also higher prices eventually. Why? Because breadth tends to lead price. And for those that are new, we need to see month to year long negative divergence on the AD line to suggest bear markets like 1930s, the 70s, the early 2000s are around the corner. So far, we have not seen that. We continue to rise. We have not seen these negative divergences. Can it start to develop now? Of course it can. We're tracking it. We need to see months-long negative divergence to tell us the next bear market is around the corner. And for now, we have zero evidence. All right. So please keep that in mind. So no, the bull market from this perspective either is not over. Okay. How we're doing on new lows? Benign. Nothing to see here. How we're doing on the summation index, it is still on a buy. Yes, we're getting a little bit overbought, but that's about it. We're still on a buy cross since January. And remember, we went almost to minus 500, which we've showed led most of the time to long-term gains for, I think, a few years, almost 25 to 35% gains with 9 to 10% somewhere around average risk. Our other intermediate to long-term trend model is still on a bull. Okay, it turned from bearish, that was in December, to bullish, that was in January, and it is still bullish. Okay, so this is still viewed as a pullback within a uptrend. And this is our short-term indicator. It did give a sell on Friday. It's been a little bit flat here for a couple of days, so that's a little weird. Maybe some data didn't get processed correctly, so I have to take it with a little grain of salt. But this is the only negative. Otherwise, the smoothed out indicator is still on the buy, the KST. So this could be a short-term just sell. We'll have to see how this develops. Okay, but so far, we've had a nice buy signal. Looks good. Okay, sentiment. So now we have gone from the most important charts, which are the price charts, to second tier, which is market breadth. Now we're going to go to third tier, which is sentiment. Third tier means this is least important. Price is the final arbiter. The rest really is secondary to tertiary. And I'm also going to go for seasonality, which is the least important, even less important than market sentiment. And as you can see here, active money managers, all right, kind of like the big boys, well, they're below average exposure to the market. So they're not so bullish. Okay. Bullish is when we are at over 100%, meaning they're leveraging. And even that is not really a sign of a top. Okay. Not at all. It could be these people are foreseeing some really good runs and they want to just be totally exposed. Okay. Not all the time, but you can see being overexposed is not a sign of a market top. Not always. And now we're kind of underexposed. We're below the long-term average. So that's interesting. How we're doing by mom and pops, 41% is bullish, 34% is bearish. That's around the long-term average, which is 37.5 to 31. So nothing to see here. A little bit skewed towards the bullish side of things. I want to see it like in, the low 30s or 20s for the bulls. That is a very good sign that we are, of course, going to bottom out pretty soon. So it's around average, nothing too crazy. If anything, a little bit lopsided towards the bulls, but nothing too much. The fear and greed indicator, which is more a technical indicator than a true sentiment indicator, where they ask people, are you bullish or bearish, is neutral to very close to fear. Okay, so just be aware this. Once again, if we get into the fear territory or extreme fear, that's a buy signal most of the time. Be greedy when others are fearful. All right, let's last and not least look at sentiment. Well, it actually is least, and this is the long-term seasonal average for the Dow Jones with 128 years of data. And it says that we should be bullish going into middle of February and then bearish, okay? However, look how January on average is, okay? Up, down, up. Is that what we got? Not really. If anything, it's been most up. So you can see here this January pattern where it's quite almost like it's not what we're seeing, okay? January has not really followed the average path where we should have topped out January 9, bottom January 22, rally February 1. Not really. Okay, it's not really good. Okay, so we're kind of leaving this a little bit from a seasonality perspective. All right, then we're going to exclude all years except post-election years, because this year is a post-election year. So then we're, of course, left with less data points, but also here it suggests that we should see a dip here in January 20th and then a rally. Again, it doesn't really match with what we're seeing so far. So are we going to follow seasonality? Maybe in February, that I don't know, honestly. But also here it suggests a little bit more bullish into the first week of February, just here as well. But please take this with a grain of salt. If January was barely followed well, what makes February then has to be followed well. It's just, if it does follow, it's great. If not, all right, just take this as a FYI. Okay, that's all there is to it. Price is the final arbiter. This is why I show seasonality last. It is least important. Don't hang your hat on it. I see way too many people post on X about seasonalities this, seasonality that. Oh my! So like, for example, February is a bad month in general. No, in general, it's actually quite a strong month. That's pretty good. If you can trade this, that's really nice. For an election year, is worse. That's about it. But yeah, again, even the election year, January, was not really followed well because we pretty much, as I showed you, had a dip and then a rip. Okay, I don't see it. We didn't have a dip and then a rip. It's quite here, rip, dip, rip. So that's what it is. All right, it's been a very long webcast. It's Saturday. I'm sitting here with my cup of coffee, doing it kind of like a podcast. I hope you appreciate it. If you have any questions, please let me know. So focus on the paths. All right, and the paths we then try to solidify and find arguments for. Are they going to be followed, yes or no, using market breadth and sentiment? But overall, we still believe this is a bull market with much higher prices to come. And once we are in this wave 5 target zones, we should be very cognizant of the idea that it is only going to be a third wave with another quite severe bear market, fourth wave, akin to what we saw here in 22, and then another wave 5. So no, we don't believe this bull market is over. The long-term charts are still 100% bullish. Take care, trade safe, and I'll see you all next week.